Picture this. You are at your desk, half listening to a boring meeting, when your phone lights up. You glance down and see a notification. Your bank balance just jumped by $1,000. You did not stay late. You did not pick up a second job. You did not flip anything online. That money showed up because you own pieces of businesses that decided to share their profits with you. For most people, that sounds like fantasy territory. But the real question is not whether it is possible. The real question is how much invested money it actually takes to make $1,000 in dividends every single month. And here is where things get interesting. The answer is not one number. It changes dramatically depending on the type of investments you choose, how much risk you accept, and how patient you are with the process. Hey, it's Dave, and in this video for Dave's Dividend Lab, we're going to walk through several completely different paths to that $1,000 monthly dividend goal, from ultra-conservative to spicy and aggressive. If you stay with me until the end, you will not just hear one number. You will understand how different yields change the required amount, which strategies are more realistic for most people, and which ones can quietly blow up your plan. Before we dive in, if building a portfolio that can one day pay your bills while you sleep sounds appealing, tap subscribe and hit like. That tells the algorithm this kind of education matters and helps this community grow. Now, let's clear something up right away. Earning $1,000 per month in dividends is not a magic trick. It is not a secret club, and it definitely does not happen in a few months. On the flip side, it is also not reserved only for people inheriting millions. The real reason most people never get there is not because it is impossible, it is because they never break the dream down into numbers and a plan. So, we are going to do exactly so here, step by step, with simple math, real ranges, and no hype. To do that, we need one concept that sounds complicated, but really is not. Dividend yield. Think of dividend yield like this. Imagine you own an apartment building. Each year, the tenants pay rent equal to 3% of the building's value. That 3% is your yield on that property. Dividend yield works the same way with stocks and funds. If a company pays 3% of your invested amount back to you each year in cash, your dividend yield is 3%. Simple. But here is the trap that catches beginners and even experienced investors. If yield is good, a higher yield must be better. Charto, that is how people end up loading their portfolio with 10% and 12% yields that look incredible on paper. Let me give you a quick story. Imagine an investor named Lisa. She opens her broker app, sees one stock paying 12%, another paying 3%, and thinks, why on earth would anyone choose 3%? She piles into the 12% payer, feels like a genius as the first dividend checks hit her account. And then, a year later, the company cuts the dividend in half, and the stock price sinks. Her easy income suddenly evaporates. That is the reality behind many ultra-high yields. Sometimes the business is struggling, sometimes the payout is unsustainably high, sometimes the market is screaming that something is wrong. High yield can be a warning sign, not a gift. So most disciplined dividend investors aim for a healthier range. They are not chasing the flashiest numbers on the screen. Instead, they focus on yields that are more likely to be sustainable, often somewhere between about 0.5% and 5%. Notice, I am not giving you a perfect magic range. Different markets, different sectors, different times. The point is this: the game is not to grab the highest yield today. The game is to build an income stream that survives decades. With that mindset in place, let us answer the big question. How much money do you actually need to reach $1,000 per month? Or $12,000 per anno in dividend income? Let's start with a solid, boring base case. Imagine you build a portfolio that yields around 3% per year. This could be a broad, dividend-focused fund holding established companies that have been returning cash to shareholders for a long time. Do the quick math. $12,000 per year divided by a 3% yield means you need about $400,000 invested. That is the price tag for $1,000 per month at 3%. For many people, that number lands like a punch in the stomach. $400,000 feels enormous, maybe more than their entire net worth today. Maybe more than the value of their home. If that is your reaction, stay with me. The goal here is not to make you give up. It is to put real numbers on the table so we can talk about time, contributions, and growth, instead of vague wishes and Instagram quotes. A 3% yield portfolio is usually built on companies and funds designed to be resilient. They may not be exciting at parties, but they tend to keep sending cash through recessions, market scares, and ugly headlines. But 3% is just one corner of the map. On the other side, you have growth-heavy portfolios with very low dividend yields, sometimes around 0.5%, but with much faster price appreciation. If you were stubborn and insisted on hitting that $1,000 per month using only a 0.5% yield, the math looks brutal. $12,000 per year divided by 0.5% is something close to $2.4 or $2.5 million. At this point, most people say, "Forget it, that is ridiculous." But here is the twist. People using this low-yield high-growth approach do not rely only on dividends for income. They plan to occasionally sell a tiny slice of their portfolio. That is called focusing on total return. Instead of thinking, "My income must come exclusively from dividends," they think, "My portfolio must produce enough overall return for me to safely withdraw what I need." Here is why this matters. It might actually be faster for some investors to build a $200,000 high-growth portfolio that supports occasional small sales than to grind forever toward $400,000 in pure dividend payers. The trade-off is psychological. Watching cash land in your account every month feels amazing. Watching your portfolio balance rise and giving yourself permission to sell shares feels less intuitive, even if the math can be similar or better. Between those two extremes, there is a middle path that many people find attractive. A portfolio that yields around 1.5% with a mix of dividend payers and growth-oriented holdings. Run the numbers again. $12,000 per year divided by 1.5% gives you something in the neighborhood of $800,000 invested. Still a big number, but a lot lower than the pure low-yield growth case. In this blended approach, you get some cash flow from dividends and some growth from the underlying assets. Over time, as your portfolio grows, that 1.5% yield is applied to a bigger number, making the income more meaningful. Before we move on, quick question for you. If you had to choose right now, which target sounds most realistic for your life, 400,000 in solid dividend payers, 800,000 in a blend, or a growth-heavy strategy? Tell me in the comments which one fits your reality today. It is not about being right or wrong. It is about getting honest with yourself, because your answer changes how you design your entire plan. Now, so far we have talked about broad strategies, but some investors get tempted by what I like to call the spicy section of the dividend menu. Strategies that promise higher yields and lower required capital, but with serious caveats. Let's start with sector-focused investing. Imagine targeting industries like energy, where many companies historically pay higher dividends. Yields of 4 to 5% are not unusual in certain parts of that space. On paper, that sounds fantastic. At a 5% yield, you only need about $240,000 to produce $12,000 per year. That is a much smaller mountain than $400,000. Here is the problem. Sectors like energy can be brutally cyclical. When the environment is favorable, everything looks amazing. When conditions flip, prices drop, earnings fall, and those generous dividends can suddenly be reduced or even suspended. You are not just betting on one company. You are betting on an entire industry staying healthy, profitable, and attractive. Sometimes that pays off beautifully. Sometimes it delivers a very expensive lesson in diversification. A second spicy strategy involves real estate investment trusts, or REITs. These are companies that own income-producing properties and pay out most of their profits as dividends. Think shopping centers, apartments, warehouses, data centers. REITs often sport yields around 4 to 6%. On the surface, that means you might only need something like $200,000 to $300,000 invested to get close to $1,000 per month. The catch is that REITs are sensitive to interest rates and economic conditions. When borrowing costs rise, or when property markets cool down, they can get hit hard. Prices can drop, and dividends can be cut. If you are comfortable riding through those storms, REITs can be a powerful tool inside a broader income strategy. But if every price swing keeps you awake at night, building your entire plan on them is dangerous. Then we have the pure high-yield route, with individual dividend stocks. You will see companies out there advertising 6, 7, sometimes 8% yields. Suddenly, the math says you only need around $150 to $200 million. For someone starting from scratch, that can look irresistibly attractive. Less capital, more income. But remember Lisa from earlier. High yield without sustainability is just a slow-motion disaster disguised as a shortcut. When you buy individual high-yield stocks, you are putting a lot of trust in specific management teams, specific business models, and specific balance sheets. If they miscalculate, you feel it directly in your income and your net worth. This brings us to the factor almost everyone forgets when they start chasing dividend income. It is not just about how high the yield is today, it is about how likely that dividend is to survive and grow over the next 20 or 30 years. You want businesses with real cash flows, reasonable payout ratios, and a history of taking care of shareholders. Companies that treat the dividend as a commitment, not a marketing stunt. There is even a name for a certain group of these businesses, dividend growers that have increased their payouts year after year for decades. They are not perfect or risk-free, but they signal something powerful about stability and discipline. Here's the trade-off. These reliable dividend payers rarely offer the flashiest yields. 2%, 2.5%, maybe 3%. That means you might still need a few $100,000 to hit $1,000 per month. But what you get in exchange is consistency and growth. Dividends that tend to rise over time, even through recessions and scary headlines. Your income does not just exist, it can actually climb faster than inflation if you choose well. Now, let's tackle a misconception that turns many people away too early. They hear 400,000, 800,000, or 200 mil and think, there's no way I can save that. Here is the important point. You do not have to wake up tomorrow with that money already in your account. The vast majority of successful investors built their portfolios gradually, over years, using consistent contributions and reinvested dividends. This is where dollar-cost averaging comes into play. Instead of trying to time the perfect moment, you commit to investing a fixed amount on a regular schedule, regardless of what headlines are screaming. Sometimes you will buy at high prices, sometimes at low prices, but over the long run, you smooth out a lot of emotional noise and avoid the paralysis of waiting for the perfect entry point that never arrives. Let's ground this with a simple example. Imagine you have $50,000 invested in a portfolio yielding 3%. In the first year, that produces around $1,500 in dividends. That is not life-changing yet. But if you reinvest those dividends instead of spending them, now you own approximately $51,500 of assets. The next year, 3% is calculated on that larger base, not the original $50,000. At first, the difference feels tiny. A little more here, a little more there, but over 10, 15, 20 years, your dividend snowball picks up speed. Growth on top of growth becomes very real, even without huge contributions. Now imagine you are not just reinvesting dividends. You are also adding new money every month. A few $100s here, maybe more whenever your income allows. Your future dividend income is being built from two directions at once. The trap many people fall into is treating dividends like extra spending money from day one. They start peeling off small payments to cover random purchases, and in the process, slow down the entire compounding engine. Think of your portfolio like an orchard. In the beginning, you need to replant most of the seeds instead of eating them. Later, when the trees are heavy with fruit, you can live off part of the harvest without hurting the orchard. Another piece almost nobody likes to talk about in dividend videos is taxes. Depending on where you live and how your accounts are structured, the government may want a slice of that $1,000 monthly payment. If you are investing through a regular taxable account, many types of dividends are treated as income. That means your $12,000 per year in dividends might shrink to $8,000 or $9,000 after taxes. In practice, that could mean you need more like $1,300 in gross dividends each month just to keep $1,000 after tax. The required portfolio size quietly goes up. On the other hand, certain retirement or tax-advantaged accounts can shield your dividends from yearly taxation, letting them compound more efficiently. The trade-off is that access is usually restricted until a specific age. I am not giving individual tax advice here. Rules differ a lot depending on where you are and what accounts you use. The takeaway is simple. Taxes matter, and you cannot ignore them when designing a dividend income target. There is another uncomfortable truth we need to acknowledge. In the early stages of your investing journey, obsessing over dividend income can actually slow down your wealth building compared to focusing on total return. When a company pays a big dividend, that is money leaving the business instead of being reinvested to grow. For mature companies, that can make sense. For high-growth companies, reinvesting earnings might produce better long-term returns than sending out large dividends. It is similar to choosing between getting a steady allowance now or reinvesting in a growing business that could pay you much more later. Neither option is always right. It depends on your stage of life and your priorities. That is why many people choose a blended path. Early on, they tilt toward growth and total return, letting the portfolio grow as fast as possible. Closer to financial independence, they gradually tilt toward reliable dividend payers. But even with all that math, all the charts, all the theories, there is one thing numbers alone cannot capture: the feeling of seeing money appear in your account without clocking in for it. For many investors, those first few dollars of dividend income are more motivating than any spreadsheet projection. It becomes tangible. You are not just saving, you are building a machine that actually pays you. That psychological boost might be worth more than squeezing out an extra 1% of annual return on paper. If dividends keep you engaged, disciplined, and consistent for 20 years, they have already done something incredibly valuable. So, where does this leave you? Let's recap the landscape. You have conservative portfolios yielding around 3%, needing roughly $400,000 to reach $1,000 per month. You have low-yield, high-growth portfolios that might require something like $2.5 million if you rely only on dividends, but potentially much less if you are willing to sell shares strategically. You have balanced approaches around 1.5% yield that sit in the middle, needing somewhere near $800,000, offering both income and growth. And you have spicy strategies in sectors, REITs, and high-yield stocks with their own unique risks. If you got value from this breakdown, do me a favor. Hit like so this reaches more future dividend investors. And subscribe to Dave's Dividend Lab so you do not miss the next deep dive. Now, I want to hear from you. Drop a comment telling me your dream monthly dividend number. Is it $1,000, $2,000, $5,000? And where do you think you are on that journey today? Whatever your target is, remember this: every portfolio that pays meaningful dividends started with someone buying their very first share. The difference between fantasy and reality is not luck. It is whether you start building your plan now